Welcome to everyone. As you would expect, and as you can see on the slide, 2023 was a tough year. Our decline of 2.4% trailed the given indices, with the exception of the TSXV, where unfortunately too many of our names resided. Our gain of 2.3% for Q4, following on a modest gain of 1.1% for Q3, left a second half gain of 3.4% that just frankly wasn't enough to give us a positive return on the year. The Q4 numbers did benefit, fortunately, from two takeouts, those being Osino and Playmaker. Looking ahead, when we look at the composition of our portfolio, we are definitely optimistic that there will be further takeovers or take-unders that will enhance 2024 returns. When we are giving our elevator pitch, we definitely focus on our 5-year numbers. Our 5-year annualized return at 16.5% is something we're particularly proud of, and it beats all of the indices across the table here. So we're really pleased with the long term. We suffered in 23. We are optimistic going into 24. Our Q1 2024 top picks have 4 new names, which you can see in the shaded area at the top, and 10 returning names. We encourage everyone on the call to reach out to the analysts where you are interested in any of their names. Now, as we are time constrained and we are trying not to flood you with too many names, we will be focusing on one name with a very brief passing reference to the second name. So there again, please reach out where you have subsequent questions and where you would like to dive deeper. Now, on that note of diving deeper, we will flip to the first specific stock, that being Kneat Technologies. Now, Kneat itself has a market cap of $235 million. In brief, Kneat provides a cloud-based software platform for critical manufacturing authentication records around quality control for regulators such as the FDA. With that, the platform was originally targeted at global pharma companies as they provide records to the FDA. In its market, Kneat counts 8 of the top 10 global pharma providers as clients. They count 16 of the top 20 as clients. It is a classic land and expand strategy as Kneat penetrates the global pharma elite, building traction within those companies while they're upselling additional services. The total addressable marketplace is $2 billion, going to $7 billion, going to $15 billion. Now, beyond verbiage, the numbers tell the real story. SaaS revenues have advanced from $9 million in 21 to 17 in 22, with 23 on track to push 30 million. They had 8 announced significant contract wins, i.e. million-dollar wins, in 2023 that give support to our SaaS revenues exceeding 43 million in 24, en route to 58 in 25 and 77 in 26. Echelon has been marketing the company and the founder over the past week, and in his words, which mean much more than mine, their backlog and the number of RFPs has never been stronger. The company is sitting on, or last reported, 10 million of cash, with 7 million available in a credit facility. We're looking at the company turning EBITDA positive this year, recording a gain of 2 million on the year. Now, free cash flow is a bit of a different story, where they are in an aggressive R&D spend mode, so the free cash flow drain could approach 15 million. This is a conservative management that likes to keep a minimum cash balance of 5 million plus. As such, we could see them raising equity or raising debt. They have a very tight shareholder base who is supportive of the company, broadening its following, broadening its profile, gaining more liquidity in the name, and we think that additional capital raises would be well received by investors. It's clearly not for deep value investors, but for growth investors, we feel it is a very strong proposition. It's valued at 7.5 times and 5.6 times 24-25 gross profit. While its would-be acquirers, Viva and Aspen are at 11.1 and 13.3. Now, we believe that an acquirer would pay a significant premium for NEET given they have 16 of the top 20. That makes them the de facto standard they go to. So we do see a takeover as a prospective scenario. I'm not calling it for it this year, but over the next 3 to 5 years, we believe this will happen. Now, in passing, I will note on the next slide that our second pick is the IT services company Converge. It has 1.3 billion market cap. The stock has been a huge win since we initiated back in August of 2020 when it was at $1.55. The stock then ran to $12 in Q3 before being hit by of 2021, before being hit by headwinds where it lost confidence. We saw it hit a low of 233 in October. It has since rebounded to 374. We believe that this is part of a longer positive run wherein free cash flow overwhelms investors and rebuilds confidence. So a name that we definitely pay attention to.
Good morning and good afternoon, everybody. Today, I elected to speak to you about Syllogist, traded under the ticker SYZ on the TSX. We've got an $11 target price. For those who are less familiar with Syllogist, what they do is like ERP software, mostly for the education sector in the US, as well as NGOs and not-for-profits. So this is the software that handles accounting, finance, payroll, HR, purchasing, in the education sector, obviously student information, and so on. Let's begin with the quality of Syllogist's business. It is high visibility. When you say ERP, it is incredibly sticky. It creates a very strong moat around the company's services. So whether you are expecting a soft, hard, or no landing at all for the economy, Syllogist is well insulated to the macro environment. It's 70% recurring revenue, and the other 30% is just implementation revenues of their software, which in my books is also high visibility. Secondly, one of the standout features for Syllogist is the margin profile, currently ranging between 25 and 30% EBITDA margins. That compares to 15 to 20% for Canadian software companies. And we actually anticipate these margins to expand further in the second half of the year. If we shift focus to growth, under the new CEO's leadership, Syllogist has actually achieved positive organic growth in the last 7 quarters. And this is actually coming from negative growth territory. What is more impressive is in the last 4 quarters, that growth accelerated to double-digit growth. So I'm not asking anybody to bet on a turnaround and a new management team. We now have a track record of sustained growth over several quarters. And what makes us extremely excited is the current competitive environment. So the company's main competitor, a US public company called Blackbaud, they're facing client renewals, and dissatisfaction among these clients is creating an opening for Syllogist. Especially in the realm of ERP, where displacing competition is a substantial challenge. We find that extremely exciting, and that's what's been pushing the growth over the past few quarters. So looking ahead, like in the next 18 months, we think they continue to displace like Blackbaud clients, and they're poised for significant growth. Adding to the appeal of everything I just told you, the company's trading at $7. Again, my 12-month target price is 11. Longer term, we think this is a $15 company beyond our 12-month targets. In terms of valuation, currently 8.5 times EBITDA at trough EBITDA margin levels. Peers are trading double that. In summary, it's cheap, resilient, offers high visibility. We love it. We buy it all kinds at these levels. My second topic, which I'll just mention briefly, is Texas. Supply chain software company based out of Montreal. If you're interested to discuss it, my line is always open.
Good afternoon, and thank you everyone for joining today. So I'm here to discuss two cannabis top picks. Those are High Tide and Verano. Just to recap, really pleased with the performance of these two companies in 2023, where they were also our top picks, gaining 18.5% for the year against our preferred benchmarks decline of 16.5%. What we are seeing is a decoupling of high quality businesses with strong balance sheets and a clear pathway to positive free cash flow. And this is something that was not as evident in 2021 and 2022, when essentially the whole sector had been on the decline. So we are seeing the high quality businesses decouple, and I think it's a great time to be getting on board these names. So with High Tide, it should be an exciting first quarter for the business. The company recently announced and congratulated Ontario on passing a new bill that would allow retailers within the province to double their maximum store count. Previously, companies were capped at 75 stores in the province. Now the cap is 150. That will allow High Tide to significantly accelerate the pace of its retail store growth in the province, and likely accelerate its M&A. So we look forward to seeing how the company continues to push forward organic growth into the new year. In addition, in the first quarter, we expect to see the Health Canada review. Health Canada has been reviewing the Cannabis Act, and early indications are that this should be a mostly business positive update, potentially lowering excise tax rates, raising the THC limits on edibles products, and reducing compliance costs across the industry, which will further accelerate the growth of the legal market in Canada. So two important catalysts that will play out in Q1 and for the remainder of this year. Meanwhile, the company remains exceptionally well positioned. It's actually the fastest growing retailer in North America, second fastest growing company, with more than 250 million of sales in Canada, as reported by the Globe and Mail. Second only to another Echelon top pick, which is Saturn Oil and Gas, and remains very profitable on an EBITDA and free cash flow basis. And the excitement also continues south of the border. In August, we saw the recommendation from the Secretary of Health and Human Services that recommended that cannabis be rescheduled from Schedule 1 to Schedule 3, moving it from the most restrictive category to a lesser tier. This is very important for the U.S. cannabis industry, including leading company Verano Holdings, because it would allow them to substantially improve their free cash flow. Many of these companies are paying taxes on their gross profit based on a rule called 280E within the Internal Revenue Code. That the applicability of that rule goes away when we see cannabis rescheduled to Schedule 3, and we do think that that is the most likely outcome. So potentially material improvement to free cash flow coming down the pipeline from this possible regulatory catalyst in 2024. In addition, the company is very solid, one of the better balance sheets within the industry, positive free cash flow today. We estimate about 96 million of levered free cash flow in 2024. And then also state level catalysts coming down the pipe. Ohio, very large state, voters recently approved adult use sales in that market. That will be implemented this year. And then Florida and PA, also two very sizable states for Verano, are also candidate markets to approve adult use sales. And finally, Verano continues to trade at a valuation discount, although it is the second best performing U.S. cannabis stock. within our coverage group in 2023. It trades at a discount, a 26% valuation discount relative to its three closest peers. So look for more gains to come as Verano continues to narrow that valuation disconnect.
GoGold is my top pick. I have $2.90 per share price target. Phil's target price is $2.80, so we're pretty well aligned on thesis. In terms of which, it really boils down to a company trading at a discounted 0.3 times P to NAV versus silver producers at about 1.0 times. It's a very well-funded company with over $90 million to build the Los Ricos project with. The rest of the capital will mostly come from debt, so there's minimal dilution risk to overhang the stock on. We're just in this lull of the Lassonde curve as permits, the definitive feasibility study, and construction decision come later this year. The reward is a company that is expected to produce around 10 million ounces per year of silver equivalent. That's not far off of what Silvercrest is producing, but at a potentially less leveraged cost, given the very wide near-surface vein relative to Silvercrest's more narrow vein, higher cost mining. GoGold has a $325 million market cap. Silvercrest has $1.2 billion market cap. So that gap in the is the revaluation potential as GoGold nears production in 2026. In the interim, you also have a few million per quarter coming in from cash flow from the Parral Tailings Reprocessing Project. That pays for G&A, corporate expenditures. That should see improving production in 2024, which should also help the share price. The aforementioned is what you're paying for today in terms of valuation, but I also want to talk very quickly about the bigger picture. The Los Ricos South underground mine will start along a 1.5 kilometer strike. That's what you're paying for today, but it's important to note that the higher grade core is the unmined continuity of the earlier Cinco Minas mine, which saw average grades of 12 grams per ton of gold equivalent in the early 1900s. So this whole area has a strong mineralized footprint, and there's about a 12-kilometer strike to further explore what appears to be a very prospective package. You also have the Los Ricos North 2.2 million ounce gold equivalent open pit resource that has an attractive PEA and is likely to be moved along the development path as well. So between those two projects, you really have a district here that the company is going to be developing. And just lastly, very quickly, I think the Mexican Explorer Developer Group has been docked due to this issue over open pit mining in Mexico. There's no real evidence to suggest that there will be an open pit mine ban. There's nothing in the new mining law that discriminates between underground and open pit mines. So I think there's a good chance that this Mexico mining risk will also eventually come off, and that should be an added tailwind to the GoGold story and also a lot of Mexican miners.
Good morning and good afternoon to everyone. So a familiar name for the Echelon folks on the call here, Pan Global. It's been a top pick of ours for a while. So these guys are advancing the Escacina copper tin project, and this is situated in Iberian Pyrite Belt in Spain. This is literally an area they've been mining for thousands of years, back to Roman times. And you know, the Escacina project actually hosts some of these old Roman era workings. So a good sign that there was some high grade mineralization there. Those guys didn't chase point anything copper back in the day. So these guys are well situated, sandwiched between some operating mines, some advanced projects. You've got the likes of Grupo Mexico, First Quantum, Lundin, Atalaya, Sandfire, all neighbors, you know, in particular First Quantum and Grupo Mexico, definitely within trucking, if not conveyor belt distance from the project here. So, you know, I kind of liken it to being dropped in the middle of Sudbury or Timmins or one of these historic Canadian mining camps and being given a prime land package that was kind of just forgotten. And that's a little bit what happened here. This package had been housed under Boliden, who of course had this the infamous Los Freyes tailing spill back in the late 90s, and they kind of left the country tail between their legs, and this land package just sat dormant until these guys picked it up. So huge opportunity here and lots of targets. project so far is anchored by the emerging La Romana deposit. Not technically a deposit yet, as they don't have a resource estimate out yet. That's what they'll be putting out in the second half of this year. But they've traced this thing, consistent drilling, methodical approach, stretched it over 1.4 kilometers right now. Still no end in sight to the northwest. Ballpark kind of in-house back of the envelope estimate here, 30 to 40 million tons at about 1% copper equivalent. This is easy mining. This is open pit from surface, vanilla processing, and that's the first target of 20 such targets. And this is a big gravity anomaly, and it's the typical corporate presentation with the glowing maps. This is how these mines are found. This is how all the neighboring mines have been found over time. Over into Portugal, gravity anomalies. That's the first step, and that's how these things are found. So this is not just corporate kind of window dressing. So they've finished a current drill program at La Romana, again, 1.4 kilometers long so far. They'll continue drilling, but they've moved over to another target, Cannabis. This one, a bit of an oddball for the package. It's their first encountering of gold values. A little bit different, like I said, from the land package and the area in general, the Iberian Pyrite Belt. So early stage here. They're not even a dozen holes in here yet, and they've really just hit the eastern extremity of a 2-kilometer long target here. Some highlights: 1.3 meters, 0.68 copper, up and 12.4 grams gold. Another 6.8 meters at 1.5% copper. So, in your first handful of holes to get some results like that on a kilometer scale target, pretty impressive. So 11 holes planned here. They're drilling those now. And again, they'll just be methodical fences across this and go from known to unknown and see what it delivers. And again, these are 2 targets out of 20. So, a lot of work to be done here. As far as catalyst, you've got those drill results from Kenyatta Honda. You've got some metallurgy, which maybe isn't a catalyst, but if it doesn't turn out well, stories do get punished for it. So looking at the tin metallurgy, copper metallurgy is already pretty well sorted, mid to high 80s recovery. Tin, an important byproduct here, lower recoveries. That's typical of tin. It is cassiterite. That's an important mineral for the tin. It's not going to cause too many processing problems, presumably. And then the big ones, you have the maiden resource that I mentioned, and that will form the basis for a PEA later this year. So, well funded for the year, $6 million. That's an important consideration with these junior explorer coasts. So they're well funded through the year. If they have to run in safe mode, they could get into 2025 as well. But really, I liken this to one of our other top picks, a long-term top pick that was Osino Resources. Again, the methodical approach. That story was always too low grade. It wasn't going to work. Namibia, water. Well, they just got taken out by Dundee Precious Metals. So I think you could have the same experience here. Pan Global just methodically de-risking, exploring, and then one day the neighbors just say, you know what? Yeah, that's pretty good, guys. We'll take that. So that's it in a nutshell on Pan Global.
On the oil and gas side, our top pick continues to be Saturn Oil and Gas, as we see the best re-rate potential in the junior E&P space by a wide margin. The primary reason for bullishness on Saturn is the company is undertaking a substantial debt reduction through 2024, and as leverage drops, we believe the stock will receive better recognition of the free cash flow potential. Saturn continues to trade at a deep discount to peers, at 1.7 times 2024 EV to debt adjusted cash flow and a 50% 2024 free cash flow yield versus the junior oil peer medians of 2.4 times and 5.1% respectively, the lowest valuation in the space. Currently, free cash flow is being directed towards debt repayment, and the market is not giving much recognition to the free cash flow today. But by the end of 2024, we see debt to cash flow falling to 0.9 times from 1.5 times at the end of 2023, and more free cash flow being freed up for shareholders into 2025. And with that, we believe the market will start to bid down the yield. Another way to look at the upside potential is the EV backfill on a stock that is already trading at a discounted valuation. Over 2024, the company reduced its EV by $1.18 per share, and should the market backfill that valuation, it would imply about 50% upside from the current share price. Secondly, we like the operational momentum in the story. In early January, Saturn reported very encouraging results on its first Bakken open hole multilateral well in Viewfield, southeast Saskatchewan. The well posted an IP30 rate of 233 barrels per day, coming in 49% of the guidance IP30 type curve of 156 barrels per day, and compares favorably to the industry sample with a peak monthly production rate just below 170 barrels per day. The well cost $2.3 million to drill, resulting in an IP30 capital efficiency of just under 10,000 per barrel per day, which compares favorably to the disclosed capital efficiency in December of approximately 13,500 per BOE per day for the year-to-date 2023 development program. With that, we believe this is a very positive and exciting result for the company, showing that this play can improve returns on forward capital spending relative to development that they've been doing in the past. Another follow-up well was brought on in December, so we expect more results from this initial foray into the play later this month. This follows a positive update received in December on the first 13 wells in its 29 well second half 2023 drilling program, where the IP30 results were ahead of type curve by 15% on average, and production increased to 27,300 BOEs per day compared to a Q3 average of 26,265 BOEs per day. Overall, the team is delivering on the development front, and we strongly believe the market will start to give more credibility to this management team and free cash flow potential as these guys continue to deliver successful results. Lastly, while crude has been challenged over Q4 and into the start of this year, mainly on demand concerns and hedge funds dumping long positions, Saturn is well hedged with over 50% of 2024 crude production locked in at a floor price of US $66.92 per barrel.
Sven here. I'm going to be covering two names, Quipt Home Medical and Diagnose. We're sticking with the same two names. They were up 4% and 47% respectively. So I'm going to focus on my laggard today, which is Quipt. For those of you who don't know the company, they're a US-based distributor of medical equipment for at-home care of patients with respiratory problems. So think of things like ventilators for people with COPD or CPAP instruments for people with sleep apnea. We like the business because of three major drivers. The first is strong demographic tailwinds from an aging population that drives consistent organic growth in the high single digits. This is very consistent and sort of recession-proof growth. The second is we consider the company in an M&A sweet spot due to its industry structure. It's highly fragmented, and it provides a lot of potential tuck-in acquisitions where they typically pay less than 5 times EBITDA for acquisitions. And at the same time, there are a number of large national players that are potential acquirers of Quipt as it scales its business nationally. And then finally, there's just an ongoing shift to at-home care. That was, of course, accelerated during COVID, but it's certainly lasting beyond the pandemic for two reasons. One, patients prefer being cared for at home, but more important than what patients want, the payers, like the large insurance companies or government payers like Medicare, prefer it too because it's cheaper to care for someone at home than in a hospital or a nursing care center, which is a higher cost site of care. So the key catalysts for the company are, continued execution on its business plan that should manifest itself in higher margins from here. Companies currently running at about 22-23% EBITDA margins. We think they could get to about 25% over time as the business continues to scale. And of course, there's always the potential for further accretive acquisitions for the company that could drive upside to our numbers and could be a catalyst for the stock. The company is inexpensive for its growth profile. It's trading about 5 times this year's EV to EBITDA, which is a discount to peers at 9 times, and historical M&A in the space, which has been high single digits, low double digits. And then really quickly, I want to touch on Diagnose. Diagnose is an artificial intelligence company with a platform to diagnose a number of different eye diseases. I won't get into too many of the details, but it's a highly scalable software as a service business model. The key thing to note about them is they've recently partnered with EssilorLuxottica, which is by far the largest player in eye care. $79 billion company, and they're working together to distribute the technology across their store base as well as to other optical retailers. We think basically that the company is turning it from what was a very promising technology play to a real commercial business. As they prove out the business model with their launch with Essilor, we think this is a company that ultimately gets taken out in the next 18 to 24 months by Essilor once the commercial model has been proven. And just in passing, Jason's name, the exit from his CEO for Coastal Contacts was Essilor as well, just to give you a sense of how big Essilor is and how they typically run their business. So with that, I'm going to pass it on to David Christo, who's going to tell you a bit about the real estate sector. Take it away, David.
Thanks, Stefan. So today I'm going to highlight Killam Apartment REIT, the dominant residential landlord in Atlantic Canada and a new addition to the top pick portfolio this quarter. Stepping back from a high level for 2024, we expect the performance of the REIT sector as a whole will be dictated by interest rates. We've seen an extremely tight inverse correlation between REIT unit prices and long-term bond yields over the past 18 to 24 months, including Q4 strength on the back of dovish Fed commentary and a year-to-date pullback on an uptick in bond yields. So once rates stabilize and central banks actually begin to cut policy rates, we expect that the REIT sector will broadly rebound. However, we do expect that fundamentals will then once again dictate relative performance between and within subsectors. So across asset classes, we see Canadian multifamily as the most attractive subsector fundamentally. This is based on a growing mismatch between supply and demand on the back of massive population growth over the past few years. And while we do expect that all Canadian apartment owners will benefit from strong fundamentals, we'll highlight a few reasons that Killam is our top pick in the space. To start with, the REIT's portfolio is concentrated in Atlantic Canada, where it generates nearly 2/3 of its NOI. Over the past 4 years, aggregate population growth in the Atlantic provinces has outpaced the national average and has benefited from net interprovincial migration, which has been consistently positive. Second, the supply of new housing has not matched population growth, with more than 4 people added per housing start over this period versus the national average of roughly 3 people. As a result of the mismatch, we've seen a 30% gap emerge between market rents and current in-place rents. Fourth, the REIT is set to benefit from looser rent controls in several core markets, including no rent control in New Brunswick, which is 20% of its NOI, and a 5% cap on rent on in-place tenants in Nova Scotia, which represents more than 30% of NOI. This stacks up versus a 2% cap in 2023 and should allow for very strong organic revenue growth in the year ahead. And finally, 2024 cash flow should benefit considerably from repayment of expensive variable rate debt and the contribution from the lease up of several recently completed development completions that should contribute fully in the year ahead. We'd point to valuation, which screens attractively on an absolute basis at roughly a 20% discount to net asset value and 15 times forward FFO. On a relative basis, it trades at roughly 4 turns lower than the peer group on our 24 estimates. And we'd note that historically, this discount versus the peer group is 2 to 3 turns lower. And we've actually seen stretches where Killam trades closer to parity with certain of its larger peers. So given fundamental strength and relative valuation, we expect that Killam will outperform the broader REIT space
as well as the multifamily REIT space in the year ahead. We'll quickly touch on our second pick in the REIT space, which is Dream Industrial REIT. Again, this is a story of a REIT benefiting from 5 years of tightening fundamentals. We should see them deliver several years of elevated organic earnings growth as they work through below market leases over the next few years. And we should see the name benefit from fund flows into larger cap Canadian REITs and sector-wide multiple expansion on the back of easing interest rates. And so with that, I'll pass it over to my colleague, Mike Stevens.
Yeah, thanks, David. So we are returning Decisive dividend to our top picks portfolio after first nominating it in Q4, where it delivered a very solid 11.7% total return in the quarter, outperforming all the Canadian benchmarks along with Decisive's peers. And really, those familiar with the name would know that this is sort of more of the same from what we've come to expect from the company. It delivered 68% total return across 2023 and north of 300% in the past 3 years. And for those that are newer to the name, the story, Decisive is an acquisition-oriented company focused on opportunities in manufacturing pretty much exclusively. So its 11 acquisitions to date have spanned a very diverse range of high quality, well-established, profitable manufacturing businesses with product offerings that include wood burning and gas stoves, various agricultural products, machining and industrial fabrication services, road maintenance and construction equipment, and even merchandising displays. So just really quickly, as far as why we like the name going forward, I'm going to give you 3 reasons, especially now in very uncertain macro, in a very uncertain macro environment. So number one, as we just kind of highlighted, Decisive is very well diversified. 6 of its 11 acquisitions have come in the past 2 years, and you're really starting to see that diversification shine through in the recent earnings reports. And at this point, we believe that Decisive is far more insulated from any sector-specific headwinds or challenges, and we expect this to be a recurring theme, this diversified strength going forward. Number 2, the company has a very strong balance sheet with over $25 million in available capital, modest leverage. So, we believe Decisive is just primed and ready to make that next meaningful accretive acquisition, and they can do so in a pretty non-dilutive way to shareholders. And just to recall their last acquisition in July of 2023, after that announcement, the stock rallied 25% over the next 2 weeks. So, from an investor standpoint, you really want to be in this when they make that next announcement, which could be, any week at this point. Lastly, number 3, Decisive has a dividend that's yielding north of 6%. We believe that dividend has a lot of room to grow here in 2024. For reference, their dividend grew 33% across 2023, and we're expecting similar dividend growth here in 2024 as well. So I'll leave things there, and as Rob mentioned up top, feel free to reach out directly if you want to know more about the name. But with that, I will pass things back to Rob for any closing remarks.
Well, thank you, Mike, and thank you to everyone. For the audience, we hope that we trust that you found the comments to be insightful, that they lead to further thought and investigation. And as we said up front, we are all here, one email away, one call away, and we would love to dive deeper. So with that, very pleased to have you for this time, and we look forward to calls, and we look forward to coming out next quarter. So all the best, and maybe healthy markets and a healthy year for everyone. Take care.